It's leg day. What's going on, everyone? Jeremy Ritz here. Courage pays better than fear trading. Happy Tuesday to all of you out there in YouTube land. Thanks for joining me here today. And yes, it is leg day. I'm going to get my workout in, and leg day sucks. Capital S-U-C-K-S. I hate squats. I hate lunges. I hate Romanian deadlifts. All of it. It's uncomfortable. It's painful. And as a tall person, it puts a lot of strain on my lanky rear end. So I am not looking forward to it, but I'm going to do it anyway. Because if I want to stay fit, if I want to stay in shape at 44 years old, if I want to get after it, you got to do the things that suck. And what a applicable lesson, not just to trading, but to life. And in trading, the things that suck: going through the losses, having account drawdowns, being wrong when you thought everything was right when you executed your trade, and it not working out. But guess what? It's part of the process, and I'm sure you've heard this phrase before: embrace the suck, right? And the bulls today are definitely embracing the suck, because the volatility, the downside pressure in the markets continues. We did get non-farm payrolls today. We did get the unemployment rate, which ticked up to 4.6% from 4.4%. Jerome Powell had forecasted it to come in at 4.8%. And the markets got a lift off of that early this morning when the data was released at 8:30 a.m., but it then sold down. And at the time that I'm recording this morning, before legs, the SPX is down about 35 points, looking pretty weak, and it seems that it wants to test the 50-day simple moving average on the daily chart. That would be a nice pullback, and that more than likely would be an area where the bulls would try again to push this up. Because really, since October, the broader markets, at least the SPX and the Qs, have just been ranging, have just been moving sideways. There haven't been true strong breakouts, pushes higher. We had that mini dip that came into play following NVIDIA earnings, but it's really just doing a whole lot of nothing, a whole lot of chop. And we know that that's not going to last forever. We know that we're going to get conviction to some type of move, whether that's to the downside or whether that's to the upside. But at the same time, when you look at all of the factors out there, sure, we are high up in terms of technicals on the charts. But when you look ahead to 2026, you have more liquidity coming into the markets because of rate cuts. There are going to be more rate cuts. Now, the first one probably is not going to happen until June, but with the labor market continuing to weaken, that's going to be a step that the Fed takes. You have Jerome Powell being replaced in May when his term is done by someone who's going to be uber dovish, because that's what Trump wants. He wants somebody who's going to support his calls for more rate cuts. So that's going to have an impact on the market. You're going to have a ton of tax breaks that are going to hit the U.S. And I forget what the statistic is, but Americans are going to see a jump in their tax refunds. So there are many, many tailwinds still in store that can continue to push this market higher. And so the drawdown, the dips, the volatility right now, to be expected, nothing to be afraid of. But that doesn't mean that we can't look at the bear case or can't have our head on a swivel, because this is a head on a swivel market. You have to be prepared for it to do either type of a move, and you have to have a plan for both situations. You can't just go into something being completely bullish. You can't just go into something being completely bearish, because you'll miss out on opportunities. And the other thing to take into consideration, we are still waiting this week for the Consumer Price Index report that is coming on Thursday at 8:30 a.m. That is going to be a significant driver to the markets. I think that's why we're seeing downside pressure right now. And we're probably going to see more drippage lower, probably going to see more chop. And until that report comes out, that's what we have to look forward to. And obviously, a cooler CPI report, better for the markets. If it's hot, we're probably going to come lower. So it's pretty basic in terms of how this thing is going to move. More than likely, it's just going to come in alignment with the expectations for this year. So we'll see. That is definitely a date that I am waiting for to see if we can get some decisiveness, a bit of a move. But like I said, today I'm just watching for a drop down to the 50 simple moving average on the daily for the SPX. If we can get that, it looks like it's going to happen. And let's see what happens from there. Let's see if the bulls step in. So that's what I got for you today in this episode of Driven. And I got to remind everyone, New Year Wealth Accelerator. You're going to be sick of me saying this, but I want everybody there. January 5th, 2026, 8:30 p.m. Eastern Time. Let me teach you the fundamentals of investing and swing trading and transform your finances, your wealth in 2026. It's completely free, people. You're not paying anything for this. And in fact, the final night, giving away $1,000 to one lucky participant to open a brokerage account and start investing. How cool is that? I'm paying you so I could teach you. So click the registration link in the description, sign up, and I will see you there on the 5th. And in the meantime, in between time, whether the bulls, the bears want to win it, want to run it up, want to run it down, want to run in circles, want to chase their tails, want to do whatever it is they want to do, remember this: make it a great day. Honor the moment, and as always, be grateful. See you for the next episode of Driven.